When looking at any reputable broker, you should see this listed on their site: FSCS Government Protection. The FSCS, short for Financial Services Compensation Scheme, is a guarantee that if your bank or broker goes bust in the UK, your money is protected up to the value of £85,000. That sounds simple, but in reality, things are much more complicated. According to the FSCS annual report, 51 financial firms declared in default in 2023 to 2024, meaning that they cannot pay off their debts and therefore could put your money and assets at risk. And if your broker does go bankrupt, you don't get £85,000 back immediately. So what happens? FSCS also doesn't cover everything. Certain products and services may not qualify for protection, and there are some important details in the fine print that you need to know. So let's look closer at FSCS protection, because if you don't know how it can cover you, you could be opening yourself up to a lot of issues. This protection is given on a per person, per firm basis, meaning you are covered up to £85,000 with each regulated bank or broker that you store your money with, but no more than that. And it also covers you if you've received poor financial advice, or if your financial advisor goes bust as well, which is more commonly what FSCS protection is used for. But what happens when you are the one investing? Well, if a company you invested in goes bust, you would lose all of your investment as their share price would drop to zero. This is because FSCS protection does not cover your individual investment losses. There's a checker online which will tell you whether your money is protected by FSCS or not, and it only takes a couple of clicks to find out, so I'll leave that link in the description below. If you're only holding money in a bank and it goes under, you should automatically receive a check within 7 days of the bank closing. This will either be for the full amount of money that you had in the bank, or for £85,000 if your total exceeds that figure. Investors don't get this same simple treatment, however. Even though FSCS protection is complicated, it's there to cover you if the worst does happen. But the real question is, what actually happens if your broker goes bust? Because while your cash held on investment platforms is protected up to £85,000, things work very differently when it comes to your actual investments. Brokers that are regulated by the FCA, or Financial Conduct Authority, have a Client Asset Sourcebook, known as CAS. All regulated brokers must comply with this if they are holding clients' money, or if they are providing safe custody of your investments. This requires them to hold your assets in what's called a nominee company with special trust status, meaning it is legally separated from the broker's business, also known as ring-fenced. Think of it like this. You're a farmer with a herd of cows, and you want to protect those cows from any predators that could be sniffing around. So you spend your nights putting up walls around your beloved Aberdeen Angus to make sure that nothing can get near them, with enough food and water for them to live off for a lifetime. That's how your money is being treated by brokers when it's held in these banks. Even if the farm goes bankrupt and shuts down, the cows are still safe. Under these CAS guidelines, brokers or banks must be able to prove that your assets are separated from their own, and they'll need to arrange independent audits to make sure they are doing this. Brokers must check their records every business day to make sure that client money matches up, almost like doing a daily stocktake of your assets. They also need to send you statements that show you where your money is being held by them, as further proof that it's safe should they go bankrupt and need to return it to you. Any uninvested cash you have, or any money you have invested with a broker, has to be ring-fenced under FCA regulations, meaning under no circumstances can your broker use their clients' assets or money to pay off their own debts. And there are even more layers in place to keep your money safe. Every financially regulated firm must hold a separate pool of cash in reserve to cover the cost of administration if it comes to that, which means they should be able to use their own money to pay off debts anyway. Usually when a broker goes bust, another broker will buy them out and your investments will simply be moved to the new broker so that your money stays in the market. If it's not bought by another broker, a special administrator should be appointed, and their top priority will be to get your investments moved to another broker for you. FSCS protection can help covering any fees associated with this too. With all of these rules and regulations in place, it's unlikely that you would ever need the FSCS to step in, but it is there if you do. A time where the FSCS would step in with your investments, as I mentioned earlier, was in the event of fraud. This covers the scenario where a broker might have somehow been using supposedly ring-fenced assets to cover their own costs. This also applies if a broker was negligent on the bookkeeping side of things and was unable to identify which funds or assets belong to which investors. So that's what happens when your broker or bank goes bust. Your money will be protected in most cases, but you need to do your own research to figure out if you would be able to make a claim. Another small thing worth considering is whether you and your broker use the same bank to store funds, because this can have a negative effect in rare situations. If you used the bank of financial interest and so did your broker and then the bank went bust, you would only be covered up to £85,000 in total, not £85,000 in each account. So if you're lucky enough to have very large cash balances, it's worth looking at where your broker stores their cash. If you are entitled to compensation under FSCS protection, you need to apply directly to get your money back. To do this, you need to go to the FSCS website and fill out a claims form. It's as simple as creating an account and entering the company's FRN or firm reference number, and if you don't know the FRN of the firm, you can use the FCA's register, which is linked here. FSCS have stated that 80% of investors have to wait for up to 12 months for a decision to be made about their claim. While this is a much longer time period, it doesn't mean that your money is at risk while you wait. If you've lost money as a result of poor financial advice from a regulated financial advisor, you also may be able to make a claim if that advisor has now gone out of business. If they're still in business and they've lost you money as a result of negligence, for example, investing in high-risk stocks when you asked for low-risk options, you can claim, but not with the FSCS. This would be done with the Financial Ombudsman Service, and you can actually claim up to £150,000 plus interest. The UK has some of the most secure rules and regulations around financial services on the planet. Multiple layers are in place, like the CAS rules and, as a last resort, FSCS protection. But this protection is rare though, because firms that stick to the rules must return your money if they close. However, this doesn't cover everything. It's a growing trend these days for brokers to offer you interest on your uninvested cash, but with that comes its own issues. The money you're gaining interest on might not be protected. I explain everything about that in the video on screen now.